What's up, team? Welcome to Channel Clarico, where we make complex accounting things simple. I'm Andy Wang, and in this video we'll be explaining franking credits. They're also known as imputation credits. Essentially the same thing. Now, as always, before we jump into it, quick note. With everything accounting and finance related, there's always nuances and exceptions to things we talk about, so please do check in with an accountant before making any, money moves. All right, with that out of the way, let's keep it frank and get straight in. That was terrible. I had to do that. That was terrible. First things first, what is a franking credit? In the simplest way possible, a franking credit is just a credit for income tax that's already been paid by a company. So when a company makes profit, it will pay tax on those profits. The tax the company pays will also give rise to a franking credit. For example, if a company pays $2,500 in tax, this will generally give rise to $2,500 in franking credits. Now, you're probably thinking, Andy, so what if a company has franking credits? How does that affect me? Don't worry, I got you. If you're a shareholder of a company and the company pays out dividends to its shareholders, so you receive them, it will normally pay dividends out of after-tax income, meaning the dividend a shareholder receives has already been taxed once in the hands of a company. As a shareholder, you are receiving money left over after the company has already paid tax on it. Then what happens is when the money hits the shareholder's account, so you receive the dividend, it's going to get taxed again in your hands. All right, so if you got taxed once in the company and once in the shareholder's hands, you might be thinking to yourself, hang on a minute, aren't I getting taxed twice then on the same dollar? Well, yeah, you are, and that sucks. Luckily, the lawmakers understand that getting taxed twice sucks, and that's where franking credits come in. A franking credit, which remember, is a credit for tax that's already been paid by a company, is normally attached to the dividends when they're paid out. The shareholders will then receive the franking credit and the cash dividend, and they can apply the credit against the tax they need to pay on the dividend they receive. Honestly, I think they should have called this a company tax credit, but can't make things too simple for people. If you're not fully following, that's okay. Let's run through an example of how all of this works. Imagine we have scenario one. Scenario one happens in a world where there's no such thing as franking credits. And in this scenario, let's pretend we have a company, let's call it CryptoCo, and CryptoCo makes 10 grand, meaning CryptoCo has 10 grand sitting in its bank account. CryptoCo will pay tax on that 10 grand. Let's pretend the tax rate is 25%. So CryptoCo pays $2,500 tax. After CryptoCo pays a tax, it will have $7,500 in its bank account. Let's say CryptoCo wanted to pay out all of its profits to its shareholder, Elon. So Elon then receives a dividend of $7,500, and Elon has his money sitting in his bank account. Let's pretend Elon's tax rate is also 25%, just to keep things simple. Elon will then pay $1,875 in tax on the $7,500 dividend he receives. After paying the tax, Elon will have $5,625 left in his bank account. Let's recap this. We started off with 10 grand, this was in the company. Through this whole process, that 10 grand became $5,625 by the time Elon had finished paying tax on it. That kind of sucks. That's a result of being taxed on the same dollar twice. 10 grand becomes $5,625 in our example. Now, let's imagine scenario two where franking credits do exist. Let's run through the same numbers. In scenario two, same deal, CryptoCo earns 10 grand and pays 25% in tax. So it pays $2,500 in tax. CryptoCo is then left with $7,500 in its bank account, same as before. But this time, because it had paid the tax, it will also have $2,500 in franking credits. Let's say CryptoCo once again decides to pay out $7,500 as a dividend to Elon. So all the money it has, it will pay as a dividend. This time though, it will attach those 2.5 grand franking credits to go along with that dividend. In this example, Elon will receive 7.5 grand in cash and 2.5 grand in franking credits. So Elon receives 10 grand in total through a combination of cash and franking credits. Let's say Elon pays tax at the same rate as before, 25%, then Elon will have a 2.5 grand tax bill. Before Elon needs to pay anything though, we can apply those franking credits that came along with the dividend from CryptoCo. Remember, these are credits for tax that CryptoCo has already paid. And this can be used as a tax credit for Elon. Elon will apply his 2.5 grand franking credit against his 2.5 grand tax bill, which completely wipes out his tax bill. Elon has 7.5 grand still left in the bank since he didn't have to pay any tax because of those tax credits. Elon is happy. I'm happy. You're happy. Everyone is happy. Let's compare that with the first example where we started off with 10 grand and ended up with 5625. In scenario 2, we started off with 10 and ended up with 7.5 grand. Not paying tax twice, it makes a huge difference. That's it. Hopefully this video has helped you understand franking credits better. And as always, if there's anything you'd like us to cover, please leave a comment in the comments section below or get in touch with us. And if this video has helped you at all, feel free to share it with someone and to give us a thumbs up. Until next time, peace.